So let's get started. So we're sitting here in January 2026. I think the landscape has shifted. The days of growth at all costs are behind us, for sure. The conversation has moved to a more sustainable scale, let's say, or resilient funding, like we talk. So today we're moving beyond the standard warehouse line to discuss hybrid capital stacks, originate-to-distribute models, and the reality of the alternative sources like family offices or high net worth capital. So we have an incredible group here. Thank you so much for being with us. Practitioners here to pull back the curtain on how deals are actually getting funded today. Let me start with Hernán. Hernán, thank you for being here. I want to start with you because in 2022, KEO World made headlines with that landmark $500 million facility. But since then, we've seen rates rise and some global funds pull back on emerging markets. Right? How are you adapting the KEO strategy today? Are we seeing a permanent move toward originate-to-distribute models where you partner with banks for the loans rather than carrying all that risk on your own balance sheet? So,
thank you so much. So first of all, KEO is a lending fintech based in Miami, and we have a platform that lends money to SMEs. We don't touch consumers, only companies in Mexico, Brazil, and in Canada. We trade to Argentina. I'm Argentinian. We tend not to pay our debts, so we don't want to.
That's going to change, though. Milei is going to make it work.
We are very optimistic. But in 2022, we managed to get a line from a fund called Haven. But granted, we were lucky. Money was almost free. And fast forward to today, the last 3 years have been very painful. There was a bit of a chicken and egg issue where we have funds saying, or banks saying, I'll give you a line, but we need to come up with 20% equity. And equity was so expensive. And we had the curse of raising in 2022 at a 50 times ARR, which I think the panel before talked about it. It sounded like a great number. Our CEO was super excited, but then you have to fulfill that number, right? So 2023, 2024, we used all the line, and we had a hard time trying to come up with new lending partners. And we shifted to a model which is essentially a forward flow model where we tell banks, do you like our product? Does it cannibalize your existing offering? When it doesn't, we become like essentially a service provider where we give them from the beginning, from the targeting of leads to, I would say, even workout, we fulfill the entire cycle of the product and the banks put the balance sheet. Now, that has made our life easier in terms of trying to raise capital, but on the flip side, we're leaving a lot of money on the table because most of the spread now goes to the banks. But at least we're not suffering anymore trying to find a private lender. Now, fast forward to 2026, I think things are improving. Advance rates are more reasonable, rates are more reasonable, and fundamentally now we have a track record. It's difficult to cash for money when your company is 2 years old and you have a portfolio of 15 million to asking for a line when we have done $1 billion now. So I think we may, having said this, we continue doing the model with the banks, but we may, for certain geographies, go back to having some lender use money and lending in our own balance sheet.
Thank you, Hernán. So let me go to Alex. Alex, from your vantage point of devotion, you're often the bridge to institutional debt. So for the founders in the room who haven't hit yet 100 or 200 loan books yet, what interim funding options are actually reliable in the market?
Sure. So when I think of every fintech lending business, they have the exact same problem as Hernán described, right? You can get a dozen credit facility term sheets tomorrow. I'm happy to introduce you to AJ first, of course.
Thank you.
But good luck getting the equity. And even when you do get the equity, there's this almost like theoretical, like we're making so much excess spread, but those growing loan books are very hungry for additional capital, right? So you always have this negative cash flow back into the loan book after you run that waterfall. Some of the things that I've thought of over the last few years is how do you solve that problem? And is it crazy to, as a lender to some of these other lending businesses, get up to and at 100% advance rate, right? Effectively, get into more of a forward flow type situation with a company at an earlier stage than anyone would otherwise be comfortable. And where the rubber hit the road for me was, if we partner with these fintech lenders, a lot of them are very good at acquiring customers, but up front they just don't have the credit chops in their own markets to really understand what their credit losses are going to be. So in taking a much more value-add approach, we partner with them, right? And we said, look, you're great at sourcing, we're great at credit, theoretically. Why don't we try and figure out how to help build that business together? And so that's where we found, especially in more developed markets, that's been our core thesis. We do across both US, Mexico, Canada, and elsewhere. But we found that to be a linchpin where when you think of secured versus unsecured lending, there's usually some sort of spread, right, for taking that additional risk. If you look at a business in Mexico, a typical business maybe making 50, 60, 70% plus headline yields before losses, maybe you're taking 15 to 20 points of losses, you get down to, let's say, 45. From there, you have some servicing, costs you another 5 points, you're at 40. If I'm a lender lending into an emerging market like that, and let's just pick a number, 15%, right? There's 25 points of excess spread in there. What's the difference in me saying, let me partner with you, let me take the additional amount, there may be an implicit first loss piece instead, but for me, I'm effectively saying there's more than enough cushion there for me to absorb those losses to a point where if I have some more active control in governing what that risk book is, it looks like, then perhaps I'm going to be incentivized to just take that model instead. So it's all about just breaking the mold of what is the box that everyone else is looking at and trying to figure out, I think time will tell whether we're smart or not, but whether that excess will actually come to fruition.
Perfect. Thank you, Alex. We go to Pedro. Pedro, we've been talking about the DeFi hype of a few years ago. You're now seeing a lot of traction in what you call hybrid capital stacks. Can you explain how you're using tranches with capitalized interest to give fintechs the runway they need to reach profitability without forcing them into massive equity dilution? And how does retail or the high net worth capital fit into that mix?
Sure. When we first started Addem Capital, it was a way different world. Liquidity was all over the place, and fintechs were growing because they had big equity investments, which hasn't been the case in the last 3-4 years. And we have gotten very creative around how we can solve for that equity not being there, for the actual distribution networks that work the right way, creating programs that are on the right path, but need some extra equity cushion in order for those creating programs to further grow. And in Addem, we mainly focus on companies that have both positive unit economics and are near profitability. So what we've been doing lately is structuring a portion of our debt agreement with a peak interest that are capitalized within the structure in order to help the company push towards profitability without losing the pace on the growth of their portfolio. And by doing this, companies have been able to have more slack when negotiating terms with further equity investors. And what we usually do is just try to make these hybrid structures on a proportion that help them reach the next stage without necessarily diluting because they need 10 or 20% more equity within each debt agreement. So that has worked great on companies that have struggled with fundraising a bit of equity between seed stage and Series A. Can help them have more negotiation power with both VCs, but also other type of investors, family offices or private equities that might be interested in taking that piece of haircut capital that it's not currently being provided by VC investors.
Great. Thank you. Let me go to Eti. Eti has a long history of raising capital across diverse emerging markets. So when you're looking at your funding mix today between development finance institutions, local banks, and commercial credit, how do you determine the right fit for a specific market expansion, for example, in Mexico or any other region you have presence?
It's a really good question. And first and foremost, thanks AJ to the team for bringing this group together. I think it's really important for the asset class to be having these conversations. By way of background, as mentioned, I lead capital markets for Tala. Tala is a global fintech focused on consumer lending across emerging markets. When we think about our core markets, we think about Mexico, Philippines, and Kenya being those core flagship markets. But we also think about new markets where we might not have as deep and robust of a track record, nor are there actual institutional investors that have appetite for those markets. And so I'll break that question that you asked into those flagship markets and into those newer markets that don't necessarily have the appetite. For those flagship markets, I think for us, it's all a matter of matching asset liability profile. So we don't want to go into a market where local currency paper is going to be more advantageous than foreign paper at a hard currency. We want to make sure that the duration of the capital matches. For us, we have a 30 to 60 day lending product. We want to make sure that we're not necessarily mismatching our cash flow profile with our liability profile. And we also want to make sure that we have institutional lenders who can grow with us in each one of those markets. What does it all look like in a non-abstract way? It means that in Mexico, for instance, we have, and this is all in public domain, a $150 million facility with Neuberger Berman that is geographically specific, great loan to value, matches the actual profile of risk that we have in Mexico. But in other markets like the Philippines, we use loan channeling partnerships and origination to distribute models. In the Philippines, you've got a robust actual discretionary income profile, a lot of new entrants into the market from BPO, and a lot of banks with a lot of savings because those new entrants have a great savings rate, but those banks don't know how to underwrite and they can't distribute in the way that we do. So there, we're actually not using the ABL model that we use in Mexico. We're using the bank balance sheets and really making sure that we have the right ROI and ROE. So hopefully that starts to give a sense of how we think about things. In the newer markets, a lot of that is finding geographically agnostic capital at our US parent company, and then dropping that in the right amount and quantum to actually finance until we can get to the track record and institutional appetite that I mentioned earlier.
Great. Thank you, Eti. So let's go to Tintin. Tintin, Moove has been one of the most creative players in the space, even issuing the Sukuk bonds. What has that experience taught you about the trade-offs? Does the complexity of those alternative instruments ever outweigh the capital benefits, or what do you think?
Thanks for that question. You all hear me?
Yeah.
Yeah, okay, great. Great to be here. Again, thanks AJ and the SixPoint team for having us. For those of you who may not know Moove.io, we are a revenue-based finance platform for gig workers in the mobility space, or at least that's how we started life, focusing on African markets, and we've now also expanded into autonomous vehicle ownership financing operations. I think the journey in terms of our capital formation strategy has been multifold. So I think there's been a lot of discussion around raising equity and the funding gaps that various debt providers can provide, hybrid and more flexible solutions. I think for us, our focus has always been on ensuring that we are well diversified and entering into new markets that drive future growth so that we can raise equity with a very clear path then to de-risk on the debt side in terms of being able to raise increasingly institutional debt facilities. But having said that, when we first started, our first market was Nigeria in 2020, where we launched with about 80 cars. And that was a very intentional decision of trading off between speed to market, i.e. how quickly can we get these cars on the road to start generating revenues, which can then pay down any facility that we raise, versus going broader and speaking to more lenders. And so in every single market that we've now launched, whether it's Nigeria, Ghana, South Africa, India, UAE, your example about the Sukuk, the UK, Mexico, Colombia, and Brazil, it's always been about what is the business model that we're operating in, because we've also learned that vehicle financing, especially in the ride-hailing space, is very different market to market. So in the UAE, it's much more highly regulated when it comes to taxi and ride-hailing services. We're not actually financing vehicle ownership in this case. There are also Islamic finance kind of considerations as well as opportunities. And so really thinking through what is the local business model, what is our product strategy, and how does that then translate into unit economics to help us understand potential cash flow profiles and what terms and structures are needed for that specific market, to then develop our debt raising strategy for that market. We did try to look at regional facilities, so working with some of the global banks to think about how we can pool different geographies that share similar risk profiles across emerging markets, but we found that just structure and pricing did not work as well as if we were specific in raising local facilities. So that's how we think about leveraging, I guess, our business model, our understanding of how we underwrite the credit risk, as well as being able to approach different types of lenders that enable us to scale.
That's great. Thank you, Tintin. Enrique, you work closely with hybrid solutions in Latin America. Are family offices and impact funds truly filling the gaps left by the commercial banks, or do their high return expectations create like a different kind of pressure for founders? What do you think?
Thanks. There's a couple of things. I think there's been some very interesting developments in terms of family office financing. In terms of, and this I give a lot of credit to founders of FinTechs in the region, in that they're being more disciplined about setting up their friends and family or family office funding, which is usually how they build up. Instead of just doing an ad hoc, having 10, 20, 15 different little lenders, they're setting up vehicles into which they concentrate some of these family offices and some of these friends and family funds. And that gives them a little bit more critical mass, gives them more discipline in terms of being able to start managing the funding, which I think is a very important step prior to going into institutional funding. So I think that's a very positive development that's been happening recently. I know of 4 or 5 companies, FinTechs, that are doing this. On the other fronts, I think, unfortunately, and although they're increasing their presence a little bit, development financial institutions are still marginal players for many reasons. The risk profile, the timing, it takes forever to get them involved. So I wish they were a little bit more involved, but they're still marginal players. Even domestic development institutions, they have some entrenched practices that will just never let them get into financing these spaces. But I think in terms of the family office profile, they're coming in, the fact that these vehicles are set up helps them and makes them feel a little bit more comfortable. Other developments that are very interesting are, and these are for the larger established FinTechs, or some of them are moving into being regulated entities, is the active participation of traditional banks. You see this with Platacar. Just in December, they did a $500 million facility with Nomura. JP Morgan is increasingly looking at some of these players. So I think those are 2 big developments. On the larger, more established companies, the fact that large institutional capital is coming in, like I said, more traditional legacy banks are coming in and funding them through more traditional asset-backed lending facilities or through future flow lending. So I think that eventually that's going to start trickling down towards the mid-sized and smaller FinTechs. And I think that's also a very positive development. Where I still think there's that little gap, and I think we're trying to unlock here, is that mezz gap. I still think that's an interesting gap, an interesting opportunity where we're trying to get more players involved, trying to get them to understand. Some of them, they're used to seeing, or there's 2 issues. One of them is size. Obviously, some of them, especially in the US, they come in and do mezz pieces for $150 million for a $1 billion facility. Obviously, that's still not where we're seeing it. So trying to bring them down market in terms not of credit quality, but in terms of the size of their commitments is still a challenge, but I think we're still hammering away and trying to get there.
Great. Thank you, Enrique. I know Rich is still with us, but I want to miss the opportunity to talk a little bit about the legal stuff. So I want to make this question, and if any of you guys want to chime in or give your opinion, feel free to do it. So as the structures Pedro and Tintin describe get more complex, the legal burden increases. So what do you think are the red flags you see more often when fintechs try to layer these different sources? Maybe, do you think that these innovative structures actually standing up to the test of local regulators, or what's your take on this, Tim, or any of you guys?
Happy to step in. I believe the underlying asset is the same. So as long as the underlying asset is on a proper setup, both over the control of the cash flows and the assets being pledged into the facility, if that's done the right way, it should be fairly easy to split that among different type of instruments that rely on the same underlying asset. Our approach has been to rely less on external legal firms and do more of the in-house work ourselves and work with the companies on early stages to help them have a proper setup that whenever that setup scales, it can be easily pluggable into different capital solutions. All of the different lending sources pretty much rely on whether or not they have control over the cash flow and the proper pledge over the portion of the assets related to the instrument. And as long as that setup is done on an institutional, professional way, it should be fairly easy to do and not necessarily involve complexity around regulation. It's more the level of depth of the service providers around all of those solutions in Mexico and in Latin America is relatively shallow, because you don't have, as in the States, lots of transactions for the same asset class. Here you have many factoring companies, many leasing companies. In Mexico, you have at the most 2 or 3 big portfolios on each asset class for fintech lending companies. Having like homogeneity on the setup, I think it's the fix for all of the participants within the space.
In addition to that, I think, so the Sukuk structure is, I think, fairly known within Islamic finance. For us, it was complex because it was our first time, and also a new lender. So developing the relationship with the new lender, going through the underwriting process, and then as a startup, also really trying to understand what are the requirements around reporting, around governance, which I think the last panel talked about, was also what made it a bit more complex. Just trying to understand what resources we need, what capabilities we needed. So those are more the considerations around how do we manage around this complexity as an organization, rather than any kind of regulatory or legal roadblocks.
Great. I think you go ahead.
Yeah, just in a practical sense, as I look out the room and see investors and management teams, I think as we think about the legal strings, number one, what we're seeing is a lot of the cross-default provisions need to be very airtight. So if you do have multiple financing sources, making sure that you're not going to potentially trigger one with potential conflicts in another. I think another one, particularly in a situation in our markets where a lot of the regulators are getting comfortable with the fintech models, is making sure that any of the amount thresholds set for regulatory adverse consequences or potential fines that are owed to regulators, a lot of the credit docs have these thresholds on a nominal numeric value, and so you have to set yours high enough such that if someone introduces a rate cap, or if you have an overzealous tax authority in one jurisdiction, they're not necessarily triggering something for the rest of your credit docs.
The only thing I'd add to that, and I think it's important for a lot of this conversation to focus on the borrower, but I also think different lenders in a co-lending relationship, whether in different parts of the cap structure, or even within side-by-side SPVs, or within the same SPV, if they're, one part of it is legal and contractual, the other part of it is temperament. And I think it's really important to understand, especially if we're dealing with emerging markets, frontier markets, right? There's all these MAE triggers, material adverse effect, regulatory, governmental. How's that other lender counterparty of yours going to react? Are they really sophisticated and know that market deeply? Are they itchy trigger pullers and want to pull that capital? What does that impact you? And how's that going to impact the going concern of the underlying business that you're lending to as well? So you can create a situation where a situation didn't need to happen just because of that. And I think back to COVID, and I've almost bore these scars, right? But for the proper governance and legal drafting, but you just don't want to get there, right? It's a mindset of partnership first, because when you see a problem coming down the horizon, the best thing to do is to get in front of it, not to figure it out once it's already happened.
That's a great point. So, following that and talking about complexity and this kind of complex products, let me ask you, Hernán, previously in a previous conversation, you argued that fintechs need to be durable, not just fast growing. Do you think like a forward flow model or product, this kind of forward flow, make a company more durable in a high rate environment? What do you think about that product and complexity?
That's a good question. I think for us, that model was a temporary solution to a problem, which was lack of capital or lack of equity to unlock credit lines. But I think we want to be a technology company. The thing part is not where the money is, in our view. The multiples are on the tech side, and when you see the way banks trade, credit cards trade, in terms of AR multiples, in tech companies, that is one of the difference. So we shouldn't be trying to borrow money and lend it at a spread. That's not our business. We should be adding technology to the product that the banks don't want to develop, or for them it's easier to just use third parties. So for us, it's a sustainable model. It requires very little equity, and again, you get the spread, but at the end of the day, your multiples are higher. So for our equity holders, it's a winning model.
Great, that's a great point on the forward flow. But Alex, I would love to get your take on how specifically you think this kind of products like forward flow impact the company, the fintech lending ecosystem in the region.
Yeah, so I think point very well taken with regards to multiples and everything like that. My broad-based punch in the face to lending markets is that lenders are inherently lazy. Right? They want something that's already proven, shown repeatability, et cetera, and we want to attach to that asset and siphon off as much cash flow as we can, right, that the market will afford. So I'm pretty cynical about that. What we found is that those that are willing to go the extra mile and actually roll up their sleeves and build some of that, I think the fintech lenders that we interface with, they're really great at origination and distribution and sourcing and all of those things. Let us just combine those efforts where we have value add to that overall ecosystem. A lot of that just comes down to street cred, right? We've been in capital markets, careers on Wall Street, whatever it is, like you have that implicit understanding with your counterparties that I think these guys are sensible and they know what they're doing, even if what they're doing is a little bit off the fairway, maybe taking a little bit more risk or a lot more risk. But the point is, if the risk reward that we can otherwise take by being more aggressive, and of course this is very much quantitatively driven, et cetera, a lot of analytics, it's taking a lot of the things that we've learned in this market and applying it to this one. So I spent 15 years in credit distress and large-scale corporate restructurings. I spent a lot of time doing quantitative analysis and derivatives trading. It's how do we take all of those learnings and apply it to what are much simpler cap structures at the end of the day with other sorts of like asset complexities and seeing how that can translate into an excess yield sense. So on a per unit risk basis, we think that we're taking more risk, but we're getting a substantial more reward. That substantial more reward is the thing that compensates us for that.
Because just to add to that, I think I'm just looking at it from the point of view of the potential borrowers or the fintechs. Forward flows are becoming, all of a sudden it's becoming a very interesting concept. And a lot of funds are starting to look at it, a lot of companies starting to look at it. But from the fintech startup side, I think it takes a lot of discipline to get into those types of models. So it is becoming the flavor of the month. But I think that it's a very different setup in terms of putting your track record in front of the investor, which is it's even more important, I would say, than obviously than doing a warehouse facility. So being able to demonstrate that you have the AR that you need, that you have the controls that you need, that you have all of these things could get you there, but it does require a little bit more discipline than just doing a traditional warehousing facility. So I think that's where the challenge becomes and try to give guidance. One of the things that we're trying to do is give guidance in terms of what do I need to be able to go to a SixPoint and say, look, I'm able to do a forward flow because I have all the requirements already met. It's not just something that say, you know what, I don't like a warehouse, I want to do a forward flow. It's very different, and CFOs need to understand that, so they need to basically get this building block approach, and they need to get, before they get to approach someone like SixPoint, they need to understand what they're asking.
Yeah. Thank you. Let me move to another topic. In the previous panel, we were talking about the importance about the exit, right? So let's talk about secondary markets. So to truly scale, we need a liquid secondary market for fintech debt. Are we seeing any real progress in 2026 for loan aggregation vehicles or platforms that allow initial lenders to recycle their capital more quickly? Are we seeing something like that? Please chime in if you have any thoughts.
I think you are seeing that in Brazil, because Brazil has one of the deepest local capital markets. So vehicles are being set up where there's secondary distribution that some underwriters are taking and then doing the underwriting a deal and then placing it with some of their LPs. So I think Brazil is definitely way ahead in that model. I've yet to see it other than here and there in other countries or in the region in general. I think a first step before getting to that is probably co-investments, where you could get 2 or 3 funds coming into the same deal, same structure, same economics, but I think that's before getting into a true distribution or secondary business. I think co-investment, having more commonality is the first step before you get there.
Very good. I think also just standardization, right? And a lot of this is just legal docs, right? When bank syndicated loans, you have an LSTA form document, you know what you're dealing with, right? You're underwriting more of the credit risk of the business, not the legal document risk. And so as you see more standardization, right now everything's more club deals, right? If we've run out of capital in terms of concentration limits, we call up Pedro, we talk to AJ, we speak with guys that we know that are of similar like mind and that we've either done deals with before or have a common goal. So I think once you get through some more standardization, hope that happens. Right now, most of the distribution platforms, they're fairly small checks, right? If I think of the percents or yield streets or other marketplace platforms, they're more focused on developed markets and they'll push further down, but it's coming. The investment banks, right, the global banks, they know that private credit's eating their lunch, and bank syndicated loans and private credit are converging on an economics perspective. So the banks are starting to trade some of that secondary paper when you have some of the larger asset managers. It's going to start with the larger allocations where there's going to be more distribution and then trickle on down.
Yeah. Anyone want to chime in?
Also, I think we are on a different stage in Latin America. Brazil is well ahead, just as Enrique was mentioning, but I think we're beginning to see a scarcity of capital not being the only driver of money being deployed into the region. It's fairly easy to do a fund in Mexico as an example because you have many companies that want money and you don't have enough money to provide them all of money. So you don't have a natural competitive market that pushes the funds to do creative stuff or even get their hands there. Like most of the funds don't even have infrastructure on their own. Now that you are having a more of a competitive situation in LATAM, you start seeing participants such as AJ, Alex, Alto, that are not only providing money and underwriting the deals, but also are creating infrastructure along the deployment. So you start getting different platforms that can end up getting in-depth deployment that can eventually lead into more volume and therefore offloading those deals in potential private securitizations or offloading those loans into forward flow agreements or more complex type of agreements. So I think we're getting there, but it's a matter of having more people actually creating a competitive landscape in order for this to be developed further, because otherwise the incentive is just not there. So if I can make a 15, 16 IRR without doing an effort because I have too many options to deploying the capital, then getting creative around how to deploy that money one translate into more flexible and more complex structures.
Great, perfect. So there's another topic I wanted to talk about currency risk management. Currency volatility is the elephant in the room. When you talk about cross-border funds, so for a funder raising USD denominated debt to lend in local currency, what do you think are the most effective hedging or structuring tools you've seen lately that don't eat up the entire margin? Because as AJ mentioned previously, we're moving to funding in US dollar to local currency, so we are taking the whole thing of the currency, but currently many fintech vendors are getting still funding in US dollars, so what's the strategy? Taking into account that not all of the currencies has sophisticated instruments, right? If you go to Central America, there is no volatility surface or call options or things like that, or even cross-currency swaps are not in all of the jurisdictions. So what's the best approach when you go to US dollar lending in local currency? Please chime in.
Sure, I'll take a stab, and I'll just use two kind of anecdotal examples to bring it to life. The first, I think, is understanding where your hedging costs are optimized and then aggregating your hedging exposure at those levels. So one of the market participants we've seen that doesn't do unsecured, they do secured lending with mobile devices as collateral. They've been able to pool their actual unhedged exposure into a vehicle and to get institutional lenders to come into that vehicle and pay them kind of a pref or a equity-like dividend to be in that vehicle. And what they've realized is that instead of having these portfolios in each of these specific jurisdictions, by creating diversified pools, hedging at that pool level depending on the currency exposure, and then selling that over to the institutional investors, they've actually been able to mitigate the cost that they would spend on forward transactions. And so what that means for them is that they grew from having this be a strategy that they use by necessity to one where they're able to scale. And I think T. Rowe Price just recently went into their structure. So you can start to see where the institutional comfort comes by having larger pools, being able to reduce the actual friction cost of that hedge and proceeding on that basis. I think the other anecdotal example is really understanding the actual correlations that you're trying to solve for and putting that in place in a real time. So for instance, if you are sitting there and you are in a market that is heavily correlated to MXN, perhaps that MXN to USD pairing is cheaper and more effective for you than the underlying currency itself, because it might not have as much float or might not have as much liquidity. And so I think thinking very creatively around where you can reduce your costs will ultimately help get institutional investors a little bit more comfortable and then save you on some margin.
Great.
Tim, what's your take on this? I would like to hear what's your take on the currency and FX volatility.
Yeah. Now we only raise debt in local currency because we've learned in our initial markets like Nigeria and Ghana, we went through a couple of years back in 22, 23, where there was significant devaluation. So I think we approached it very simply, and that was using cross-currency swaps, which you mentioned, and just using that as a test case to ensure that we can continue to pay down the debt, manage the volatility as best as we could, to continue to demonstrate our track record, and as quickly as possible, raise new facilities in local currency to then take out the original hard currency lenders. So nothing as creative as what Eti was talking about, but it was just pushing through, using more traditional structures, but knowing that there was an intention to refinance local lenders as soon as we had scale and track record. And so now it's essentially fixed interest and also local currency in all cases across the board.
I would comment that as well. Operationally, we had to make some tweaks because in Mexico and Brazil, we were getting loans in USD, and literally 80% of the cost of our structure was the hedging. So we were paying in Mexico 13% to a fund called Haven in the UK, and they were asking us to hedge, and that was 6.57% hedge in the Mexican peso. So when we did first operationally, we tried to reduce costs and having shorter and rolling credits, so we're taking 45, 50 days, so you're hedging almost on a by monthly basis, as opposed to a yearly basis. And second, trying to get more USD borrowers. I'm trying to find niches in Brazil and Mexico that they need dollars, and the local banks are very reluctant to provide USD loans. But ultimately, I think that the four-flow model, going back to the point, help us too, because now it's not a problem anymore. Now we have whatever servicing fee, whatever origination fee is in the contract, and the bank, we assume, is more effective at hedging their own book. So I think that kind of kills two birds with one stone. And that's been good for us in terms of, okay, we don't get that much credit because we don't worry about those concepts.
Let me touch one final point on the ESG topic. So when we work with DFIs, with development and finance institutions, that often comes with strict impact reporting and compliance. It's not so easy. So do you think that this lower cost from Addem Capital worth the increased operational reporting and lengthy due diligence we will be seeing in 2026? What do you think?
No. I don't want to be cynical, but we rather, I'll give you an example, we rather not play in certain industries than to deal with the additional burden of meeting some ESG patterns. Sometimes you have to play that game, and sometimes they ask you the questionnaire. And you can always say that we increase, our clients have increased the labor force by 20%, so there's always metrics that you can use. But I would say that as a firm, we're not going to radically change our compliance. And we already started paying millions of dollars for that purpose. I think there's lenders that are not as, I would say annoying, but it's not the word. The lenders that are not as strict when it comes to those metrics.
It also depends on the cost benefit. It depends on the size of the facility or the funding that you might get from these DFIs. Again, for larger, well-established companies, it might make sense because if they're going to get a 15 million or 75 million facility, it's worth the investment in creating the infrastructure for monitoring this. But if you're a mid-sized or a smaller company and you're borrowing $5 or $10 million, it becomes really a question mark, because these monitoring systems, they're not cheap. They eat up a significant amount of your capex, and so it all depends, I would say, on the impact that that this facility would have on your operations more than a strict guideline to follow.
Having been through that process with IFC, we're one of our first lenders. It took about 18 months to close the 20 million facility. We've now paid that facility off, so I'm very happy about not having to be required to submit an annual report every year. I was also in charge of setting up the environmental and social management system at the very beginning. We had no one in the business doing that. But actually, in hindsight, I would say it was beneficial in a few different ways. First, it forced structure in a chaotic startup environment, because fundamentally understanding where certain areas of risk could arise in the business is actually helpful in terms of instilling that perspective in the local operations teams. And then I would say the second benefit is in that, again, as a startup, having the credibility of being backed by the likes of an IFC opened many doors for us. And also open doors on the equity side as well, because many of these DFIs have private credit pod as well as an equity pod. And we were put on platforms to be able to tell our story and to share our narrative and to raise our brand awareness within the investor ecosystem. And so those are quite intangible. I can't say that their interest rates were actually catalytic or more preferential than other lenders we work with, but in a more intangible way, I think in hindsight it was worth the pain that we went through, but now know what's possible and what's available to us having been through that process. And I can only say that we're better for it.
And to that point, I would segment the market a little bit. I think to your point, in a non-consumer SME or more commercial lending environment, perhaps that ESG framework or lens perhaps is not as necessary. In consumer fintech, particularly when you're dealing with low ticket size items, the rep risk is so prevalent in terms of over-indebtedness or potentially getting yourself into a situation where your product is perceived as being a little bit predatory. And so I think that ESG framework and that kind of lens provides you with a bit of a defense shield against those potential pitfalls.
So before closing, I want to hold relation from both of you, following the AJ's thing in the previous panel. So the question is, by the end of this year, December 2026, what will be the single most dominant source of capital for emerging market fintechs that we are not talking about enough today? Go ahead.
I'd say, which I mentioned earlier, is the increasing participation of commercial banks in the space, either through capital markets issues or through structuring larger facilities, syndicated. We're seeing that in Mexico, significant, there's, I mentioned LATAM, but there's other borrowers that are taking that are rooted. So I think there's going to be a lot more visibility with commercial banks. Obviously, we're talking about size as well. These are deals that have to be at least $100 million plus. But I do believe that we're seeing increasing. We're going to see a lot more of their presence in this year.
This may not come to fruition by the end of 2026, but I think a broad-based theme that we're seeing in the market is hedge funds, dare I say traditional hedge funds, right? Those that are used to dealing in private market and public markets are creeping into privates more and more. And that doesn't just mean doing one-off credit facilities or anything like that, but they're used to liquidity. So they like short-dated assets, intraday ticks, being able to trade out of positions, but some of the things that fintech lenders put out there in the market could be 7, 14-day loans. They could be 2-3 month terms. That's getting to a point where that bridge in liquidity is actually meeting their abilities to meet their own investor liability side, right? If they have quarterly redemptions or other things like that. From some of our institutional capital partners and backers, we've seen a massive interest in a lot of these types of assets because they know that if things go wrong, they can unwind fairly quickly. And yes, there isn't a mark to market, so to speak, but there's an ability to run down the book and amortize in a very quick fashion. So I don't know that it's 2026, it'll be a massive part of the ecosystem, but I think in 5 years, they're going to be a very dominant player in that overall forward flow and asset purchasing.
That's interesting. Thank you, Alex.
If I can cheat a little bit and answer your question, Jose, I'd say in terms of the biggest things 26, I think one is going to be different by quantum and size. The other is going to be really important in terms of growth rate. So in terms of quantum and size, if we think about it, emerging market debt is like what, 28% of global bond issuance? And if you strip out local currency corporate issuance, it's something like 17%. So if you think about the numbers that AJ threw around earlier, $1.7–2 trillion of the private credit market, emerging market private credit has to grow. At least if it's going to mirror what the public liquid bond markets have done. So I think that the institutional market in terms of allocators, pension funds, insurance companies, liability-driven investors, they're going to become a bigger source, particularly as they look up and realize that their books are over-indexed to US dollar risk, right? A lot of this asset-based stuff is cutting up student loans, car loans, different tranches of the American consumer. Now they're going to want the diversification benefit, particularly in a new macro geopolitical environment. I think the second thing that we're really not talking about is the use of stablecoins and decentralized finance. So when we think about USDC, USDT, when we think about the ability to minimize friction costs, when we think about the ability to issue permissionless tokens, I think that not by quantum, but by growth rate, you're going to see a lot of penetration of these decentralized finance players becoming the source of capital for our markets.
A quick comment, and I think I agree with everyone that you see more commercial banks, investment banks, hedge funds going to LATAM specifically. But the problem we have in LATAM, and I was advised before, is that this is an orphan market. You have the $5 million deals that go to local family offices, and then public courts saying, hey, do you have anything over 100 out of West that can participate? And there's $20 to $50 million of fintech companies that cannot get capital because they're not that very, or that small. But I think we're up the next thing. And then another issue is that from the US, they tend to think, or we tend to think, I mean, here, my years, LATAM. But if you live in Colombia, like in Peru, like in Chile, it's 3 legal teams, very expensive fees. It's not LATAM. So I'm hoping that what you're saying becomes true, that with that smart contract, stablecoin, you get some more uniform data across the countries, and it's easy to get volume. Because that's when you get the big layer of the hedge funds and the banks.
Related to Hernán's answer, I believe we will see a lot of liquidity coming in on a different way on JVs from not great platforms that want to enter into the lending space, that have strong distribution networks, have already reliable data, but do not know how to do credit, and credit firms that want to rely on this network and don't have these long negotiations with fintech entrepreneurs. We've seen more and more credit programs growing out of nothing. When you combine credit expertise with strong distribution, disregarding it was not a native-born fintech. So I believe we'll get to see more and more of that. And that's an easier way to build 50, 100 mil portfolios than building a fintech from scratch.
Great. Indeed.
Everything's been said, so it's pretty easy. But maybe just one nuance in terms of what Enrique was talking about with more commercial banks coming in. I think we'll also see, especially when we're talking about FinTechs, the opportunity for strategic, so JVs or strategic partnerships with commercial banks that want to invest in origination platforms, that want to be able to deploy via leasing programs in different parts of the world, because many of them do have global presence, and so that I think that will also be very interesting.
Great. Okay, so let's give an applause to our panelists.